And this is what I'm going to talk about today: market, about buyers, about the values and the process, how the process works. And all these things are very connected. So market is very important because it does changes from the industry to industry that you work in. Buyers are super important because they drive the price. It's not what you want to sell it for or what I want to sell the business for, but it's what the buyers want to pay for it. And we're going to after that talk about the valuation. So hopefully after today you'll be able to go home and do some sort of calculation to get an idea of what your business should worth. It won't be exact, but you'll have a really good idea of what you can expect to sell the business for. And we're gonna talk about the process and what to do and how to do it and how to make it better when you're doing it and how improve chances of selling a business. Disclaimer: you'll probably see about 3-4 disclaimers today. Pretty much says your individual circumstances were not taken in considerations, and after this we can say whatever we want. Yeah. So market. I'm going to talk about the market first. So how big is the market? We think it's somewhere between 30 to 40,000 businesses are at the market every year. So over the 12 months, this is the number of the businesses that goes on the market. So how we calculated this? We actually look at we counted the odds for the period of 6 months. We counted the odds. We took some averages because not all of the businesses actually go on the market. A lot of businesses are done. A lot of sales are done internally when the owner offers the business or somebody approaches the owner to sell the business. So it's somewhere between 30 and 40,000 businesses end up on the market every year. Not all of these actually transact. Not all of the businesses sell. So it looks like this. If you imagine that each of these blue dots, it's one business, that's how it looks to the buyer. And one of the common comments that we get from the buyers goes, so much out there, and it's so much stuff that's misrepresented that we can actually understand, and it's very, very messy. These blue dots, that's about probably 20% of the businesses have done some sort of preparation and were taken to the market, not just put on the market, but actually done some small presentation. And I'm going to show you how to stand out in the market, to become one of these red dots, how to become a 20% of 20%, which I think works out to be about 8%. Take my word on it, but you can calculate it. And if you do this, you should find a buyer within 90 days. That's what normally takes to find a buyer if you have done everything properly. We have done the deals from the beginning to the end, from the moment when they go on the market until we actually complete the deal in 4 weeks. But that's exception to the rule, not the rule itself. Normally within 90 days you should find a buyer, and then it should take you something like another 90 days to complete the deal. That depends on lawyers on both sides, on the advisors to the both parties, and on complexity of the deal. It could take way longer than that. So who are the buyers? All right, this is what we've done. We've done a survey of 700 buyers that actually were on the market. They came to us to buy the businesses. And then we've done the same survey with same buyers 18 months later. And we find that only 2 out of 10 have actually either still looking to buy the business or have purchased the business. All right? So out of 10 people that come on the market, 8 of them will give up. All right? They're going to say, look, this is too hard, I'm not doing it. And when we looked at why they don't buy the businesses, this is what came up through a survey. 20% of people decided, for whichever reason, it's either not for them, they decided that they don't have what it takes to own the business, their circumstances changed, then they decided not to buy the business. But the rest, 80% of the people were distinct 2 groups. One group told us, look, we found a business that we thought that was well priced, but we could not get information from the seller. We just could not trust the information. We had to fight for the information. We couldn't understand the business, and we decided not to buy. The other group was the people that said, look, we found the business, but it was overpriced, and we just couldn't agree on the price, and we walked away from the deal. So basically, if you do these 2 things, if you price the business well and you present this business well, you increase your chance of success by about 80%. And this is how the buyers are thinking, all right? So this is somewhere along in people's lives, they decide, these are private buyers, these are not businesses, they buy other businesses, but a private buyer wakes up one morning and said, look, it could be a good idea to buy the business. Like, for those of you that are in business, they think, look, I want a freedom, I want to enjoy, I want to call my own shots, I want to work my own times, and then they buy a business and realize it doesn't work that way. But that's why they do wake up and decide to buy the business to actually improve their life. But they're not sure if buying a business is the right thing for them. So they started with a bit of a market research, and it's the first step in their journey. And with this market research, what they do, they start looking at the websites for businesses for sale, talking to people, and start investigating businesses just to see what's out there, what's selling, how much is selling. And actually in that first stage, they got no idea what business they want to buy. And in many cases, maybe they decide to go and buy a childcare and end up buying a bookstore, right? Through the process, whole process will help them actually crystallize what they're looking for. And then they find the business and they say, oh, this could be the business that I'm looking for. So they do a little bit more investigation. So they go and meet the owner, they get a little bit familiar with the operations of the business. And they'll do that with quite a few businesses before they go, wow, look, we got a business, this could be the business I'm looking for, I could buy this business, and they put the offer. And what often happens is people, the offer is submitted to seller, and he said, well, I've got a done deal. And you can see that you're about 1/3 of the way to the end. So then we accept that offer, and then we start negotiating. Now, this is an interesting point. First thing that's always agreed on is the price. We got a list of 27 most important points, but how many points need to be agreed? It's probably infinite number. And you need to agree how the stock's going to be valued. You need to agree what restraint of trade is going to be applied to transaction. You need to agree of what type of handover period you're going to give to people, and the list goes on. So we do this negotiation, and let's say we negotiated on all the parts, and they put a deposit, and then they start in the due diligence. So what happens here, until then, they were on their own. They didn't involve their accountant, they didn't involve their lawyer, they didn't involve anybody into this process because it's costly, and they do this many times over. Now they bring their lawyer, now they bring their accountant, now they bring their mother, sister, father, probably about 7 people into this process. And you almost have to go through each time through sell and through negotiation with every time with a new person comes into the process. And if you complete this due diligence correctly and agree on the terms of the contract on the end, you're going to have purchase, and then takeover still stands. So you may not going to even get all the money on the day of the settlement. But I want to just illustrate this to you from the buyer's point of view, how the process works and what you need to think about when you're selling business. So I'll move down to value. So these 3 circuits illustrate the points that will define the value in your business. So there are 3 parts to it. One is profit, and everybody, like, it's the only part of this that's exact science, it's a profit. So we calculate the profit, and I'll talk a little bit more about what we call profit. So the profit is a mathematical formula. You calculate it, you add back all the private expenses and all one-offs and whatnot, and you come to the profit. But the risk and the market are not that, it's a soft science. It's more art than science, I would actually say. So the risk of and risk is the part of the valuation formula of the valuation component that will impact price of your business, or value of your business more than the profit itself. And we'll talk a little bit more about it. And then you got the market. And earlier, just before we start, I was talking to a few of you, and somebody actually mentioned that they're in IT industry. And if you are not in IT industry today, the market is really, really buoyant. We took a business to market last week in IT industry, which was actually telephony and IT, and $2 million mark. In about 7 days, we had 160 inquiries, and they still keep on coming. If you take something like a plumbing business, you're probably not going to get more than 30 or 40 inquiries through the whole process. So market really drives the, it does have an impact of the value. Market itself, in most cases, there are some exceptions to this, but not going to double the value of your business, but definitely will help you sell the business faster, and it's going to increase value that you achieve on the end to some extent. For example, pre-Royal Commission, if you had a accounting business, what was happening with accountants? All the financial planners were getting in cahoots with accountants, and they were buying accounting practices. And if we had a 10 a day, we would sell them all. After the Royal Commission, the market changed drastically. So you really have to look at the market where it is. If you're in construction, new construction, I think we're hitting a little bit challenging market at the moment because of, you know, with the way it's, market is changing. But if you're IT or have any type of online business, the market is working in your favor. I'll talk about more of these, about every single one of these elements more now. This is how the buyers are looking at the business. Very simple formula. There's about 32 different methods that you can value the business. None of those methods is of any use to buyer. This is how they look at it. They said, okay, I've got a profit, and profit is $100,000. I'm going to multiply this profit by something, and I'll show you what that something is in a second, and that's my value. And that's how they all look at it. Everything else is irrelevant. Well, it does have small relevance, but profit and that multiplies how they calculate the business value. So what's a profit? So profit is not what you got on your tax return on the bottom, all right? So every accountant in the room is going to say to you that they always work as hard as they can to bring that profit as close to zero as possible. And look, this is, these are legitimate tax deductions, and your final tax lodgement, it doesn't reflect your business, but it's a document that's prepared for the tax department for the purposes of estimating your tax of your taxable income. So it's not a true reflection of your business. So what we need to do is we need to look at this. These are the main points. There's more. So we're going to look at the profit that shows on the bottom of that tax return. And then we're going to add to that any once off. So for example, I don't know, you spend $20,000 on putting a new carpet into your office, and you won't have to do that for the next 20 years. We're going to look at any paper expenses such as amortization or depreciation. We're going to put them back in the profit. Owner's personal expenses, which is borderline, should it be, but what they put as a personal expense. I'll give you an example. Let's say you got a company car, and company car costs you $70,000 a year because you got a brand new Merc, but you can actually do the same job for Hyundai. So the difference you can actually add back into the profits. Owner's wages get added back into the profits. The owner's wages that you paid to yourself, this is very important. And then we take out of it owner's market wage. And why do we do this? Because your tax return or any financial statements, or you may going to choose to pay yourself only $50,000 a year because it suits your tax position, but the fair market wage for you should be $150,000. It could work opposite. You could be paying yourself $250,000 for the wage, but for the position that you're having in the business, you should pay yourself $100,000. So it needs to be adjusted. Now the question is, why are we looking for the profit after the owner's wage, not profit including owner's wage? So you'll see that later on a little bit more. But the reason is this, because if I'm a buyer and I'm buying your business, I'm giving up my potential earning that I can earn in a job. So if I've got a job of $100,000, I'm giving that up. So I didn't buy myself $300,000 profit, but I bought myself $300,000 profit less what I could earn somewhere else. So you're looking at profit over and above what you can earn by exchanging your time for money. So what's multiplier for your business? Also very important point to actually understand. And often people come to us with these, they do mainly on Excel, they'll do just some calculation, and they're going to go times 2, times 3, or times 5. Well, the difference between 100 times 2 and 100 times 5, it's about 5 times. So I'm going to give you an idea how the people looking actually on the different investments. So you got to compare your business to other investments that any buyer can actually invest the money in. For example, if you invest money in government bonds, you're looking about 5%, a little bit lower at the moment, but depends on what government bond you actually invest the money to. Like if you invest in Greek bonds, you're going to get way more, but I wouldn't suggest you do that. So that represents about 20 times multiplier. So I'm happy to get 5%, which means on my $100, I'm going to get $5 every year back. So that's a 20 times multiplier. Next is commercial property. If you take any commercial property, you're looking, that's return, rental return, plus some capital gain. You're looking somewhere between 7 to 10, depending what type of the property and where the property is. After that, you go to share market. Share market, 10 to 70% accepted returns. So you're looking 6 to 10 times multiplier. Below that is a private business, okay? So no one's gonna pay more than 5 times because it makes more sense to put the money into shares because it's liquid, you can sell it like this. You just one click and you get your money back. And it's also totally passive investment. You can keep your job, do whatever you want. It's gonna make you money on the share market. Now, private business is somewhere 1 to 5 times. So maximum you're gonna get for any private business, unless you get super lucky, but that happens one. And I had one case in 15 years that somebody got 7 and they were not selling business, but somebody approached them. Now, just to give you an idea, we see about 1,000 businesses a year. In 15 years, well, first year I wasn't seeing 1,000 businesses, I was seeing less. So let's call it 10,000. So chances of that are 1 in 10,000. I don't know if you're a betting person or not, but I wouldn't put any money on 1 to 10,000 odds. So you're gonna get somewhere between 1 and 5, all right? And it's a big range. So I'm gonna try to answer this question to where your business is. Is it a 1 times profit or 5 times profit? So multiplier for your business. So what we've done, we said, okay, let's make this 5 times multiplier. Let's make this imaginary business as a benchmark business and say, okay, this business will attract 5 times. But it needs to be established for minimum of 10 years. You're not gonna get it 5 times business that you just started yesterday. You need to have audited financial records. So it's independent auditor. It's not what you give to your accountant and you sign off, but actually independent auditor audited those records. Complete management structure, board and management in place, which means you don't run the business, but there are different layers of the management and the business run itself with some sort of input from you, which is mainly strategic input. EBITDA needs to be minimum of $1 million. So you're not going to get the 5 times for something that's making 300 EBIT. It has to be minimum $1 million. Sufficient number of employees that if you lose today 20% of your workforce, you still can run a business without too much interruption. No customer should represent 5% of your business. It's kind of logical because you don't want to have all eggs in one basket, but I have seen and we have sold the businesses that have only one customer. Not a pretty place to be in, but it does happen in business. Established market position that actually you've been around, your first mover or you've been around long enough, did you have an established position on the market that kind of protects you from the others? Strong customer suppliers agreement in place. Very important if you do any importing or any representation of someone else's product. Most processes and operation manuals need to be in place. No reliance on the owner for day-to-day operation, increasing profit, clearly defined future opportunities, and non-declining business industry. So you can't expect to sell for 5 times retail at the moment, all right? So this is 5 times. This is the business that's gonna get you 5 times. And most of the small businesses currently in Australia do not fulfill most of these points. So where are the deals, all right? So currently deals are about 3 times. Okay, so if you're making $500,000 in a business and your wage should be 100,000, your profit is 400, you will get that somewhere between 2 and 3 times. Could go a little bit over 3 times, could go a little bit under 3 times. Very rarely goes below 2 times. And that's driven by the owner, because if the owner gets pushed so far, then they say, well, maybe selling the business is not best way for me to exit. Maybe I should close it down, sell off the stock, run it for 1 or 2 years, and then give it to the family and let them pay over 10 years. If I get the money, I get the money, I'm still better off. So the deals are happening somewhere between 2 or 3 times. Most of the businesses sell around 3 times EBITDA, which is profit after the owner's wage, but a little bit under or a little bit over depends not so much on your business, but how do you run the process. No one does this. So people wake up one morning and say, look, I'm going to put the business on the market, and just go and put it on the market. So no one does. Well, most of the people don't do any preparation. Like, funny as it is, just the fact that you're sitting in this room, you're probably in like less than 2% of the population, and thinking, well, I'm thinking of putting a business on the market. Maybe I should see what's it all about before I actually put it on the market. Normally people come to us, something happened either in their life or in their business that actually made them need to sell, and they get on the phone and said, listen, can you help? We need to sell, and we need to sell yesterday. That's normally how it works. And these are the 3 components that you need to prepare. You need to prepare business, you need to prepare yourself, and you need to prepare the sales process. Now, some people do something on preparing sales process. Few businesses are prepared to some extent. No one prepares themselves for the process. No one. So how do you prepare the business? We came up with this RUDE acronym, just so it's easier to remember. And so you got to remember 4 letters. RUDE stands for risks, uncertainty, doubts, and economic appeal. But it starts with the risk. So you got to ask yourself, okay, so the best way to think about this is think about if you are buying competitors' business, and not just any competitor, but that closest competitor that you always come against, the guy that you really don't like that much, and the guys that you really enjoy stealing a business from. If you're buying their business, what would you see as a risk? Because the buyers will see same point in your business or as a risk. So ask yourself, what would be the risk components in this business, and how I would address them? Risk is the measurable possibility of the loss in the business. So if you got a 30% of your clients or of your income coming from one client, you lose this client, you lost the 30% of the business. So what you got to do with the risk, you got to minimize it. Now, it's not possible to eliminate the risk totally, because it's a business. That's why it goes for 30% or 3 times profit. That's why we're selling it. But you can minimize it. Uncertainty is something we simply don't know if it's going to happen. And I actually had something probably last week, I think it was Wednesday, that they came to us and said, look, we got this new contract that we got it, and it's not ready yet, but we got a verbal go-ahead. How many times in your business you had a verbal go-ahead and you actually didn't get a contract on the end? And that's uncertainty. Another big uncertainty in the business is lease. I've got 1 year lease. So what's going to happen after that 1 year? Are you going to be able to renew the lease? Just the fact that the lease was renewed 3 times before, it doesn't mean that it's going to be renewed 4 times. So that creates uncertainty. Uncertainty, you need to minimize it, but even better, try to eliminate it. Try to eliminate any uncertainties. Doubts are statements and facts that can be proven. Look, I've got this contract, it's definitely coming my way, but I got no way of proving. Big part of this is in cash business is the portion that we don't bank. So there's a part of the money that hasn't been banked, and they said, look, but there's more money on top of it. It just wasn't recorded properly. It's impossible to sell. So again, doubts need to be either reduced or eliminated. And economic appeal. How many people can buy your business? All right. If I'm buying a business and I need to be a plumber, and the business is going for $1 million, I need to be a plumber that has access to $1 million. And your market from everybody goes down to very, very niche and small number of the people. But if you still got a plumbing business that kind of has a manager and he's got a project manager, he's got a few management levels, and I give you 100% vendor finance, all of a sudden everybody is my market. I'm not saying, by the way, to go and give 100% vendor finance to everybody, but just to illustrate how you can increase economic appeal. In some of the businesses you don't need to do that because the market is good, but some of the businesses you really have to work very hard on this last one to find out the way to actually sell that business to people. So how do you work with this route? Well, very simple. You identify and then reduce, eliminate, or increase. Now, preparing yourself. This is something that no one does, all right? People go on the market and the selling business becomes a do or die decision. I'm either going to sell a business or I'm going to perish. And it happens so many times that your negotiating position is really, really bad, that you can't negotiate because you don't have an option B. A couple of things that you can do. One nice way to do this is to do this, and we're going to talk about establishing asking price, is start with the asking price and decide what your exit point is. And then test that exit point. So asking price may going to be $1 million, but my exit point is going to be $800,000, out of which $600,000 is today and $200,000 12 months down the track. If I don't achieve price in between, I need to know what my alternative to selling a business is, all right? Alternative to selling business could be management buyout, could be, if your alternative is drop down the price lower, well, you didn't decide on exit point very well, all right? Now, what we need to do is to have a really, really good alternative to selling a business. Otherwise, selling a business is really going to become a nightmare. I'm going to try to illustrate this. I'll try something and I hope it works, all right? Now, imagine you're there. This is, let's call it Xcllusive truck, all right? And you come to this sign and it's a December. It's about 45 degrees Celsius outside. And you driving your family on this holiday of the lifetime, and you're in the car, and everything is going really fine, all right? And you come to this sign and say fuel 441 kilometers, and you look at your fuel gauge, oh, we'll be all right, okay? So you keep on driving. And then somewhere halfway through, you see this, and you're about to run out of petrol. I was on Xcllusive truck and we had a problem with the car, and it was a pretty difficult situation. I didn't run out of petrol, but imagine if this happens. Now, people die in these situations. You've got the 2 kids and your partner in the car, and you start sweating and you're really not comfortable, and your partner's looking at you and says, is everything all right? And no, it's all cool, it's all cool. And no, seriously, something is wrong. He said, listen, we got a problem. We got 200 kilometers to go. I got no petrol. I don't think we're going to make it. What are the options? Option A, leave the family in the car on the sun without the aircon, and you walk on the sun without the aircon. Option B, wait until night comes in and then leave them there. Option C, wait for somebody to maybe turn up and help you out. It's pretty difficult, isn't it? All right? So you know really, really good. So your partner says, look, don't stress about it. You remember that jerry can or 40 liters that you bought to, I don't know, wash some tools at home or do something with it, and it's been sitting there for 12 months. When we were packing a trailer, I put that at the back. So yeah, we got another 40 liters. If that happens to you, your situation, if I manage to take you to this journey properly, your situation would change instantly. You wouldn't be stressed. You wouldn't be scared about it, for anyone's life or family or anything like that. The situation would be totally different. It's exactly the same if you got an alternative to selling the business. Do yourself a favor before you put the business on the market. Ask yourself, what is my plan B? And make that plan B real. Your exit point is just about the plan B. If you get an offer between exit point and your asking price, be prepared to accept it. So asking price. How do you establish asking price? Okay, now, in our industry there's a joke that goes around, and it's very accurate. If you want the fastest way to value the business is ask the owner what he wants for it and then half it, all right? And it's amazing how accurate that is, all right? And that's what people do when they take a business to the market. I believe that 80%, probably more, of the businesses out there are way overpriced. Actually, 40% of the people told us, I found the business I wanted, but I just couldn't agree on the price with the owner. So this is what happens. If this is price and this is time on the market, this is fair market price. Let's say this business should worth $1 million. People put it for about 1.7 to see what's going to happen. Another thing that people do, they look at what the other businesses are selling for, that they think they're similar, but they don't know, because you don't know all inner workings of the business and details of the business. And then they said, okay, well, my business is better, because we always think that our business is better than someone else's. So he's offering business for 1.5. Well, my business is better, and I should leave some room to negotiate, so I'm going to put it for 1.7. This is what happens. You go on 1.7, the buyer comes in, looks at the business for $1 million. He's not going to give you an offer. He's going to walk away from the deal. Two reasons. First, he's either thinking you're not serious about selling a business, or he thinks, well, the guy wants 1.7 million, and I think it's worth 1 million. It's not comfortable to offer you that low. I don't want to insult you. And they walk away from the deal. So what happens, most of the buyers come in first 90 days. They actually come in first 4 weeks, but let's call it 90 days. So most of your buyers come at the beginning of the process, because they are keenest buyers. They're the guys that have been on the market for 18 months. Finally, the business that they think, wow, this is the business that I want. They come in first, they come in fast, and then they find that the business is overpriced and they walk away. So what happens, the seller starts dropping down the price. Finally, 12 months later, he's on the market price. He's $1 million, where he should have been when he started. But the urgency factor is gone. If I take a business that's worth $1 million on the market for $1 million today, you have to move fast, because you know, if you're a buyer, that someone else will move. If I take a business for 1.7 that's worth $1 million, what's the urgency? No one's crazy enough, so no one's going to sell it right away. No one's going to buy it right away. Year later, the business is on the market. If you see anything selling for a year, house, if you see the car selling for a year, or business, first thing that you think, what's wrong with it? I mean, why is it on the market for a year? What's wrong with it? Business becomes a stale, and we can't even... It happens to us when somebody else or the owner tries to sell business themselves, and then we take it on, and they said, oh, it's their business. No, not interested. It's been on the market for 12 months. Have you looked at it? No. It's been on the market for 12 months. Hang on a minute. Have a look. All right? So what happens here? The only alternative that you got here, because whatever caused you to put a business on the market at the beginning, it's probably pushing you even harder now. The only alternative is to go below the market value and sell this business. If you price this business right, and that's the secret that we do. It's not a... We make it like it's a secret, all right, but it's not. It's not a rocket science or brain surgery or anything like that. You price the business where it should be, and it will sell very, very quickly. Now, people ask, well, no, hang on, Zoran, look, your people will always negotiate, all right? Logical. Well, let's imagine that you want to buy a car. And let's imagine that the car costs $20,000, and you know that the car costs $20,000. And I'm selling a car for $20,000. And you say, Zoran, I'll give you 15. And I say, no. Are you going to walk away from the deal, but you know it, $20,000 is good value? Or are you going to try to buy it for $20,000? No one walks away from the deal just because you didn't drop the price. They walk away from the deal when they couldn't agree on the fair market price. So you really need to trust our advice. When we tell you that the business is worth something, that's what it's worth. How do we do this? Where we look at those three components, we look at the risk, market, and we also work a lot with comparable sales. We're selling this stuff every day. And we also don't sell all the businesses. So I can tell you why the businesses didn't sell, and we use that experience to actually tell you exactly what the businesses should sell for. Most of our businesses sell within 10% of what we go on the market. Every single of our businesses sells for the range that we appraise the businesses. So if we say the price is X, we got 10% up and down, because it's not exact science. Every single one of them sells in that range, never below. Oh, this is a good one. What to do if somebody approaches you to sell the business? Now, I always say prepare. I always say price your business right. This is one time you don't want to start with the price. If it happens to you that tomorrow somebody knocks on your door and said, listen, we're thinking of expanding, and we want to buy your business, you got to say something to this extent. Business is not on the market. I've got a long-term plan for this business, all right? And I honestly wasn't thinking of selling, but if the price is right, everything's for sale. Now, what I need you to do is to tell me what exactly do you need, what information you need from me in order for you to determine what price you're going to pay for the business. But two things we need to agree before we do this. One, we're not going to negotiate. You're going to give me a price, I'm either going to accept it or we're going to walk away so I can carry on with running a business. And two, don't come to me with a fair market price because I'm not selling, you're buying. So it needs to be more than what I can do on the market. And leave it at that. Put a timetable, say, look, here's all the information, come back to me in 4 weeks, and we're either going to do the deal or not do the deal. If they come back to you with a price that you think it's good, and you said you're not going to negotiate, still negotiate a little bit, all right? But don't tell them that in advance. And if the price is better than the fair market price, do accept it because they'll probably happen only once in your lifetime. If the price is not good enough for you to sell it at that point, don't sell it, just run the business. Now, I have seen so many times that this happens and 12 months later we're still negotiating. So what happens when you try to sell business for 12 months and you're not focusing on your business starts declining because you're 1 foot out of the door already, all right? So don't do that and don't tell them what you want to sell it for. Let them tell you the price, but don't accept fair market price. Sales process, we came up with 3 P's. We came up with these ideas, like just so it's easier to remember. Like we made them all up. They're not real. All right? So we got a people, paper, and presentation. All right, you got to prepare the people. Don't do it on your own, especially if you've got a strong management. Now this is the hard one. All right, people often say, "Ooh, you want me to talk to my managers about selling a business?" We can sell a business without anybody knowing until the deal is done. But if your manager is part of the business, you'll probably get a better price. So maybe it's a good idea to offer a little bit of incentive to manager to help you, some sort of monetary incentive for manager to help you sell the business. The reason, and we all worried about selling a business because what if my employees find out and they leave? But the employees are worried that if somebody else takes business, what they're thinking is, what if they don't need me? So it's all about the job security, all right? Now, buyers are also worried that the employees go. Everybody's worried about each other, but no one talks to each other, and that's where the problem is. In most of the cases, I don't say all of them, but in most of the cases, less than 1%, that's an issue. So these are the people that you need to inform, all right? Partners, shareholders. On top, I have had a situation that we come to the pointy end and we find out that the shareholders actually don't know that the business is on the market, all right? This is your team. This is your team, these people you have to have from the beginning, not on the end, from the beginning. You have to have your accountant, you have to have your solicitor, business advisor if you have one, business agent, which is us, very important, and management. If you got a strong management, try to find a way to involve in selling a business. Now, any other crucial employees? If you're selling a restaurant, I think it's a good idea to get chef involved. Landlord and suppliers. This is where people start jumping up. Oh, I'm not telling anything, especially in retail or any business that you're dependent on a landlord. I'm not saying anything to the landlord until the business is sold. Why wouldn't you? Well, I don't want him to find out and try to do something, I don't know what, imaginary things. The issue is, the fact is this: if you're going to have a difficult landlord, it's better to know at the beginning of the process than once when you got a buyer. We do lose the deals when the landlord is involved too late. It becomes difficult. By the way, the landlord's got nothing to do. To landlord, this is a problem, all right? Now, he needs to involve his solicitor, he needs to, so he's not really that keen to do the deal, and there's no pressure for him to act very fast. And sometimes because of that, they get upset because they didn't know, so they become really difficult. Even though they legally should not be difficult or got no right to be difficult, they will commercially be difficult. And sometimes the buyer says, well, hang on, I don't want to have this guy for the landlord. I'm better off not buying this business and moving on. So talk to the landlord in advance. Suppliers, if you got any crucial contracts, don't even try to sell business without actually talking to them. This is the information, this is the paperwork, and do take a notes, but pretty much you got to have all the information available. 3 years tax return, 4 buses, bank statements, 12 months proof of purchases, any software you need to open up for the buyer. Let them look through. Let them look through, let them, employees contract. Very often we go on the market and there is no employees contract. It's a good time to actually sort them out before you go on the market. All clients' contracts, lease, documents, suppliers agreement, licenses, approvals, proof of ownership. Not unusual that you will have certain equipment or certain software that's crucial for your business that was purchased years ago that people don't have any paperwork and we can't actually transfer the ownership, so it becomes much more difficult. Stock take. Stock take I can talk for about 2 days about it, all right? So what the seller thinks that the stock is, buyer most definitely won't think that the stock is. If you had something for 4 years, buyer's probably not going to want to buy because you didn't sell it for 4 years. He doesn't want to take that liability and just have it sitting there for another 4 years. Training and operation manuals if you got it in place. And what do? You put it into document 15 to 20 pages and you prepare what's called information memorandum. So that information memorandum, these are the points that should talk about the business. A little bit, I'm going to go very, very quickly through it. A little bit of a history, description of the market, products, pricing, special trends, everything that person needs to know about that business in order to read the document and say, well, actually this looks good. They're not going to buy it based on this, but they're going to make a second step. Now, remember, most of the businesses there on the market don't have anything like this. So people will feel way more confident looking at your business and purchasing your business because this information is available to them from the beginning. Now, this is how you protect your confidentiality. It's very, very simple. Buyer comes in, makes a first contact with the agent, signs a confidentiality agreement. We screen the buyer. We actually don't screen the buyer. Buyer screens himself. He looks at the business in the information memorandum and says, this is not for me, see you later, so we don't bring him to you. Information memorandum, buyer establishes an interest, and then he comes to your business to look at your business. Most of the times, it's done this way. There are certain people that said, look, that's not good enough for me. I'm really worried that they're going to find out and the world's going to find out. So what we do, we give them limited information, which often doesn't even give a name of the business. Then we gauge the buyer's interest. Then we give them full information memorandum. Then we bring them to the business. There's another strict approach which we introduce another point, which is we meet outside the business. They normally come to our office or, in a coffee shop, so with torches at night to look at the business. and it's very complicated. And what happens often, after about, we are happy to do this just to satisfy the seller. And after about 2 of these meetings, seller goes, man, this is too hard, just bring them all right? I've been doing this for 15 years, and twice we had situation that the news or the fact that we're selling a business has leaked out. And in both of these cases, no damage has happened. All right, so look, 40 to 30,000 businesses sell a year. It's not uncommon, and most of the buyers know about this. Now, handover. You got to prepare this at the beginning, but I left it towards the end because it's a handover. All right, happens in the end. So this is how the handover. Don't expect that somebody's going to give you money, he's going to take over your business, and he's going to ride into the sunset, and he's going to run business successfully, and you're going to have all this money. You will have to do some sort of handover. So you got to, because often people were in business for 10, 15, 20, 30, 50 years. A lot of knowledge and connections inside your heart and inside your head. And you need to pass that on to incoming buyer. So we try to split this into 4 steps of the handover. So the red point on this little graph is, this arrow here is owner's involvement, current owner's involvement. This yellow one is new owners. When somebody buys a business, first part of the business, I can't go in and start running this business. So I'm going to go in the business and I'm going to look what you do and start understanding a business and to meet employees, to meet the suppliers, to just to get understanding. Then the old owner is going to start doing less and less work, when the new owner, under supervision of old owner, is gonna start taking over the control of the business. And then slowly new owners takes control of the business and the old owner just fades out. It's a good idea to say to, when somebody's buying a business, look, if you purchase my business and we're gonna do 3 months handover, on the end of that, I will be available on some sort of consultancy basis for you for a certain amount of money and make this price worthwhile for you. But it'll give them that safety net, that if something comes up, they got this opportunity to call you, to engage you, and they'll pay money for it. What happens in the real life, let's say this goes for 3 months, somewhere around here, they want you out. Look, okay, enough, just get out of here. This is my business, don't tell me how to run it, and I'll run it. But having a good structured handover will help you sell a business fast and help you get a better price. So it's your responsibility to sell a business. It's not buyer's responsibility to buy the business, all right? So you don't fight with them. They're your friends. You need to help them buy your business. More help you give them, better result you're going to have in the end in terms of money. And this is how it works. This is how you help somebody buy the business. When somebody comes to buy your business, their mistrust is really hard. They actually don't trust you at all because they already seen 20 businesses and they find the holes and misinformation in them. So they believe that everything you say to them, it's not true. And desire to own your business is very low. Your job is to reverse that. So if they start trusting you and their desire gets out here and really want to buy your business, that's where the purchases happen. If you don't do this, no sale. So if you do something like this, yeah, okay, I'm kind of trust this guy, but I'm really not that keen on this business, they're going to walk away from the deal. If you do this, if they really, really want your business, but they don't trust you, I guarantee you, you will not sell that business unless you dramatically reduce the price that you're selling it for. So price needs to offset the risk. If it's something like this, they really trust you, they think you're the best person in the world, but they don't like your business, well, it's not a business for them, nothing you can do about it. So you got to do this. If you do this, the sale happens. How do you do this? What's the best way to actually trick somebody in trusting you? Well, not tricking them at all, be honest. You can't trick somebody in trusting you. What you need to do is to be open, you got to be transparent, more information you give them, disclose all the issues at the beginning of the process. Don't let them find out anything, not by hiding, but actually telling them at the beginning. So if I tell you that my chef is leaving and I'm selling a restaurant, I'm taking restaurant as an example because we all know how they're operating, and you say, okay, let's talk further, well, we already overcome that issue. If I don't tell you and you go through the process and we agree on the price and then you find out that the chef is leaving, even if you're a chef, you're not going to buy that business because you're thinking, what else you didn't tell me? If you've done any seminar in the last 300 years, you heard this, all right? You should start preparing your business for sale from the day you started, all right? Totally disagree with this, all right? There are 4 kind of parts in growing the business. First one is a startup. Don't worry about selling a business in the startup. Pay that bill, stay solvent, somehow survive. I don't care what it takes, but survive this first part. Then the business starts growing and starts growing rapidly. Also not a really good time to sell the business, all right? Because I was talking to one of our analysts in Sydney this morning, as soon as I landed here in Brisbane, and she said, I've got a problem. I've got a business they made catering business, all right? Caters to hotels and corporates. And he went from 100 profit to 150 profit to $800,000 profit. Are they selling because it's 800,000? They know it's not going to happen next year? Or they're selling because they think that the business is going to stay at 100? Really hard to establish, especially in the first 2 meetings, all right? So it's possible, it's doable, we're going to sell it. We're not going to maybe use that as a base, but buyer will really scrutinize that, and if they have any inkling that that business may not going to achieve $800,000 a year, it's going to reflect that in their offer. Try to sell the business when it's growing So after that boom, it starts growing, gets that plateau. If I have a certain business that I use as an example, and you've done 750 and then 800 and 850, everybody believes this is stable business. Now it's 850. We're going to use that as a base. And again, don't wait until it starts going down, because this business never goes up like this. It only goes up forever on the spreadsheet, all right? But in the real life, goes up and down, up and down. So don't try to sell it when the profits are declining, because there was some change in the industry. But fix that up and then put it on the market. And I'll leave you with this: better business you got, better value it has. Do stuff that's going to make your life easier. That's going to make that business more secure, and you know deep inside what it is. So all these improvements to the business, they're going to make your life as a business owner better, will improve the value of your business. It's very logical. And that's it. That's it from me. Thank you very much.